Hello, where do Singaporeans invest their money? Yes, of course, the home market of the Singapore Exchange is the #1 destination, according to surveys. But the #2 destination is not Kuala Lumpur, is not the Hong Kong market, it is in fact the US market. And if you already own shares in the US or are thinking of doing so, Scott Connor's here with me to talk you through some strategies that you could employ in order to make the most out of your investment. You're Director of Education at thinkorswim. So tell us, what can the option market offer us if you are thinking of the US markets?
Absolutely. There's a couple strategies that we can talk about here, but one in particular that for people who are new to options often ask me, what is something I can use and start with options to help me as a beginner? So in other words, I own stocks, I own US stocks, I own US ETFs. What's something that would be appropriate or suitable to me as someone who's new to options, so to speak? So one of the things I tell them about is there's a strategy called covered calls. Now, covered calls is not a strategy to protect your stocks and portfolio, in other words, ETFs, counter stocks. It's a strategy for people to use to augment the returns of those stocks while they own them. Does that make sense?
Right, so you have stocks in your deposit account of some sort, and now you're waiting for it to appreciate, you're getting a bit bored, you don't want to wait for the dividend, you're thinking, how do I milk more value out of this stock?
Exactly.
Right.
So once you've chosen the stocks that are appropriate to you and you've diversified that portfolio, and that's why many people use exchange-traded funds in the U.S. to diversify, because that one product, which is treated like a stock, has a broad base of stocks within that exchange-traded fund. So options are available on those as well. So how do we actually go about this, and how does a customer increase their returns or enhance the returns while they own a stock? Well, first you've got dividends coming in, which is one thing. And certainly we hope that your stock appreciates over time. But what's something I can do to add to that? So here's what I tell them about. There's a strategy called covered calls. Now, the way it works is for each 100 shares that you own of a particular stock or ETF, you can sell one call option. So let's say we own a stock at, pick a number, $100 a share. And I believe that that stock is going to increase in value. But each month, or every 30 days, I'm going to sell a call based on my 100 shares. Now, if I had 1,000 shares, I could sell 10 calls. Now, let's say we had 100 shares. I own it right here at 100, and I'm going to sell someone the right to buy my stock at 100 shares from me at 110. Now, they only have that right in the next 30 days. Now, if it doesn't get up to 110, then whatever that person paid me for that right, I keep. And of course, I keep my stock as well, or my ETF. Now, what if the stock goes up to that level? Well, then the person that I sold the call to, has the right to take my stock from me, but they must pay me $110 a share. Plus, I get to keep what they gave me.
For the options.
For the option, exactly. So what I'm saying is, if you think about it, it's a little bit strange, because here I own a stock at 100, and somebody comes to me and says, I will pay you right now, let's say $2 a share, for the right to buy your stock at 110. Now that seems counterintuitive to a lot of people, that why would someone come to me and say, listen, I will buy your $100 stock at 110 and I'll pay you $2 a share right now.
Yes.
And I'll only have that right for 30 days, right? So that's the idea. So what's happening is each month, if we own stock, let's say at 100, we're giving it plenty of room to appreciate during the next 30 days, which is a 10% move, right, in this case. And we hope it goes to 110. That would be fantastic. Now, we might lose our stock because the person has the right to take our stock at 110, plus we keep the money. So in that case, we would have to repurchase our stock around 110, and then of course maybe we'll sell the 120 call. But you see, each month you do this process over and over again. So it's an enhancement. In other words, how much could I expect to get each month selling this covered call strategy? And to be honest about it, we shoot for something of about 0.5 to 0.75% per month. Now, that doesn't sound like a lot, 0.75 or 0.5%, but annualized, that's 6 to 7 to 8%. Now, if I can add that 6% to the historic 100-year return in the market, which is about what, 7
thereabouts,
7 to 8% dividend or excluding dividends. Now I've got a good return that's going to give me, if I've used the rule of 72, and I can maybe perhaps shoot to double my money every 5 years instead of every 9.
Right.
Does that make sense?
It does, but let me maybe test you on a couple
Sure,
of these points.
please.
The first is coming back to that question of why anybody would buy, pay you $2 per option to buy your stock at 110, to use your example. The reason they would do that is if they believe that your stock at 100 is going to go to 120, 130, 140, whereby they can then exercise at 110 and they get to keep the profit. So your risk actually is that you leave money on the table, isn't it?
Absolutely. So, again, options they expire every third Friday of the month, so every 30 days. So the person who buys that 110 call, and you're absolutely right, they think the stock's going to go up and appreciate. And so do I. That's why I own it. But they think that's going to happen in the next 30 days. Now, how often does a stock go up 10% in 30 days? That would be fantastic. If over the last 100 years, the average rate of growth is 7% annual,
yes,
how many stocks go up 10% a month? So you're absolutely right. So there may be occasions where the stock would run up 10%. Well, that's okay. You'll get the 10% that month. But again, you're right. You might lose your stock, and then you'd have to go back in the market, buy your stock, and then do the covered call strategy again.
At a higher price. And I guess the other concern then is that, if you price the strike price too high up,
absolutely, then
obviously nobody will buy your option because they might think, well, the stock is never going to go up 10% in the next 30 days.
Absolutely.
So you have to pick the right strike price, don't you?
Absolutely.
So how do you do that?
So what you look at is what is the kind of return I want to get. So let's say I want to get an extra 6% a year. That means I'm going to have to get about 0.5% a month. So let's just look at it that way. If your stock's at 100, okay, and I want to get 0.5%, I want to sell an option that's about 50 cents in value. Does that make sense? Okay, so I'm going to look for the option that's going to give me about 50 cents in value. What you'll find is that's probably going to be an option, if it's a $100 stock, probably going to be somewhere between 107, 106, maybe 110, something like that. Okay, so that's one of the easy ways to start and sort of get a general idea of where to get started. Many people say, well, Scott, I own exchange-traded funds or broad-based investments or what they call mutual funds. Unfortunately, mutual funds do not have options, so that door is closed. But if you own individual stocks or exchange-traded funds, this door is open to anybody that wants to learn about option strategies, and right, this strategy in particular, the covered calls.
There was a second strategy, and that is to sell puts. In other words, selling somebody the right to sell you their stock.
Right.
So how does that work?
Okay, so the first one we talked about is if I own the stock, I give someone the right to buy it from me higher. Now they're going to pay me for that. That's great when I already own stock. But what about instances when I see a stock that's come down, for example, and I've done my homework fundamentally and technically, and it's a stock I would want to own. But perhaps not right now, because I still think that might have the room to drop just a little bit further, and then I'd like to purchase. Okay, let's go back to our $100 stock again. Let's say it used to be 120 and it's come down to 110, but things are turning around for the company. I've done my homework. I'd now like to invest in that stock, but maybe not 100. Maybe I'd like to buy it at 90.
Maybe that's the book value, for example.
For example, right. Exactly, perfect example. So how could I buy the stock at 90 or at my discounted price? Well, there is a way using options. So what you do is now we use puts. We don't use calls, we use puts. And what we do is we say, okay, the stock is at 100. I'd like to buy it at 90. So what I do is I sell a put with a $90 strike price. Now all that simply means is that I'm now obligated to buy 100 shares at 90, even though the stock is currently 100. So if the stock drops down to 90, I will buy the stock at 90. That's what happens when you sell a put. You have the obligation to buy 100 shares. Now, what's the risk there? Well, the risk is just as it is with any time you own a stock. It can go up and it can go down from there. So if it does not go down to 90 in the next 30 days, what happens? Well, I just keep the money that I earned when I sold someone the put. So it's kind of the opposite of what we did before. Someone is actually paying me to buy the stock $10 lower than it is now. And I know that seems totally counterintuitive, but that's exactly how those options work.
Because the people who buy those options are worried that actually the stock will fall a lot further, maybe even to 80. So being able to sell you their stock at 90 actually gives them some downside protection.
Right. So they're doing it for protective reasons. You're doing it because you'd actually like to purchase that stock or exchange-traded fund at that discounted price.
Because the market is always about buyers and sellers.
And it's not just public customers that are doing it themselves. There are big, huge money managers are doing the same thing. They will actually try to buy a stock at a lower price by selling thousands of those puts so that they can hopefully accumulate hundreds of thousands of shares at a lower price. Now, if they don't, well, they just keep the proceeds from the put they sell each month.
Right.
Does that make sense?
It does.
Okay.
And are we going to hear more from you during Singapore Investment Week?
Absolutely. I'll be giving a talk the first session. I believe it's 11 a.m. So we'll get a little bit more, and I'll talk a little bit of how a customer can actually get started learning about options and finding a trading platform that will help them do that.
And you can find out more about this seminars on the website on your screen now, cs.org.sg/SIW 2013. Scott Connor, thank you so much for coming in.
Thank you. It's been a pleasure being here.
So if it's that easy, then what's the catch? I mean, what is the most that you could lose out of all of this?
Well, you have to keep in mind that, so let's say a stock was at 100 and I want to buy it at 90. So I sell the 90 put. Now, you must only do this strategy when you really want to own the stock. So if people think, well, I'm just going to do that each month because, well, I'll make the put money because the stock will never go down. Well, they're right that the odds of it going down that much are low, so it's a low or a high probability trade for them, but they must be prepared to own the stock.
And what happens if they can't? Let's say they've bought all these puts and then they can't afford to buy them.
Okay, so if you sell all these puts and then suddenly it says, well, now you have to own 1,000 shares and you don't have enough money in your account to hold 1,000 shares, you're going to have to reduce the amount of shares you keep. So you must always stay within the limits of your account.
Right.
Now, what will also happen is at most brokerage firms, they'll say that, well, listen, I'm not going to let you sell all these puts because we know that if you do own all the stock, you will not have sufficient capital. Right. So they actually will not let you. They'll say, try selling a lower number of puts.
And that's your role, presumably.
That's our role, exactly. Right. So we won't let the customers get into those situations where they would find a point where they would have, well, supposedly like a margin call, for example. Right. So yeah, we keep close tabs on that.